Executive consultants, you're welcome. It's been a week of looking at different areas of QuickBooks and Tally, and then we looked at the different standards, in particular the group accounts. And like we promised, today we are going to look at IS 7, or the statement of cash flows. Now, what is this statement of cash flow? The statement of cash flow is a third document. It's a third statement that is prepared by accountants at every end of financial year, that is accompanied to the income statement and the balance sheet. Now, one might ask, if we have the balance sheet and then we know the financial position of our business, and then we know if we've made a profit or loss by use of the income statement, why the statement of cash flows? Now, the statement of cash flow is important because it emphasizes the liquidity position. It puts its emphasis on the liquidity position of the business. And by doing so, it helps us to see or to note down the actual physical movement of cash in and out. And that is why it is normally called the inflow or outflow statement. So today we are going to basically look at it, and we are going to understand why is it even prepared by accountants, even after preparing the other two financial statements. The main purpose is to reconcile the profitability of the income statement with the liquidity stand. Why? Because you're going to realize that at the end of the financial year, the income statement will report a loss or it will report a profit. And either of the two will prompt the following scenarios. For example, if the income statement reports a high profit, then chances are high that the employees will ask for a pay rise, and then the shareholders or the directors will then end up saying, we need to share, we need to get some good dividends. Or still, we are going to see that at the end of the financial year, the body that is in charge of collecting taxes, which is URA in Uganda for this case, will ask you to pay income taxes which are probably not supposed to be paid. For example, you have 100 millions as your net profit, yet in the actual sense, you have less than that. So to avoid all that, we need to reconcile the profitability of the income statement with the liquidity stand. Or the public might still be misled simply because they have seen the income statement, you're performing well, the financial position is also showing you're performing well, yet in reality, you are not performing well. And that is where we need to come up with IS 7. Now, there are two methods to prepare the standard, the statement. It can be a direct method or an indirect method. The IS standards, the standard recommends a direct method, but because of its complexity and its expensivity, we find people world over going in for an indirect one. Why is it a bit complex to use direct? A direct method is going to be using both cash and then the accrual basis at the end at the same time. Whereas when it comes to the indirect method, it is still going to only call for an accrual kind of accounting. So that is why in most cases, world over, most people use the indirect method when they are preparing their IS 7. So we are going to see the skeleton. I'm not going to go through the notes because I believe by now, if you're watching this video, you've probably read and now you want to understand a few things which I believe I'm going to be hitting on as we look at the skeleton. I call it a skeleton, but they call it a pro forma. They call it the format of the statement of cash flow. And when I open it, this is how it runs. It runs the IS7 has 3 sections. It has the operating activities, it has the investing activities, and then the financing activities. What is involved under the operating activities? We have 3 subsections under the operating activities, and that is the non-cash items, where we need to do adjustments, and then the working capital, where we also need to do adjustments, and then the taxes or the duties that are paid by the business. Now, let me start with the non-cash items. There are cases of depreciation, amortization, which are non-cash, and we need to do workings for us to arrive at the depreciation charge for the year that was charged, and then we need to add it back. If it is amortization, we need to add it back. And then things like and then things to do with provisions, things to do with loss on a sale or profit on a sale. So all those adjustments, like we'll be seeing how to arrive at them when we are looking at a number, they need to be done. So that for you to arrive at those figures, because we know non-cash items like depreciation, they are going to affect the profit that is made on a sale, and then the loss. Why? Because that profit or loss is already going to be, it's already dependent on the asset that was bought at cost, let's say 2 million, and then you depreciate it by 1 million, and then when you sell it at 1.5, you call the 500, you call it a profit. Yet in actual sense, that was not a direct cash inflow into the business. It is as a result of the depreciation that you as a company, you set up to depreciate the car or any machine or any asset that you're selling. And then the same thing applies on the loss. Probably you've depreciated your asset, and then you sell it at a price lower than the NBV, and then you say it is a loss. So such cases need to be adjusted, and then they need to be added back or lessed accordingly or respectively, like we'll be seeing. The other section that is under operating activities, it is to do with the working capital. And when it comes to working capital, it is going to be either payables, receivables, and inventory. So they are simply telling us that if it is an increment in accounts payable, then that means we need to make adjustments. What does it mean? It simply means that you've brought in goods from suppliers at without you paying, and that calls for an inflow. But if your accounts payable reduce, then that means you're moving money out of the business to pay the creditors. And that's why we are saying when accounts are reducing, that calls for an outflow. But if they're increasing, that is an inflow. And then when it comes to accounts receivable, it is the opposite. When the accounts receivable are increasing, then that calls for an outflow. Why? Because you're selling the items that you bought using cash, you're giving them on credit. And it is not cash that is moving, but that stock that you're selling on credit is the one that we are considering as an outflow. And then when it is decreasing, that means your debtors are bringing back money into the business. And then for the inventory, of course, if it is increasing, then that means you're bringing in more inventory, and hence you're using cash to bring in inventory. And if it is reducing, that means cash is coming into the business because you're selling out most of the items or the stock. So the other area that is under operating activities is interest paid, and then the taxes that are paid. Now, it is only the operating activities that may make someone really have a little bit of workings and a little bit of challenges, which are normally okay. But for investing activities and and financing activities, most of them are just clear off. Probably disposal, acquiring of an asset. It is all about acquiring and disposing of an asset. That is basically involved under the investing activities. And then the financing, you're either issuing debentures, you're issuing you're getting a long-term loan, your dividends have been paid. That means you're paying out money. Then redemption of debentures, you're paying out money to bring back the debenture before it matures. And then the repayment of a loan. And eventually you're going to be sending out money. Like we'll be seeing when we begin looking at a number that we'll be looking on. Now, the other two important workings that you need to work on before you do anything are here. When you're getting the operating profit before interest and tax. Now, we need to work backwards for us to arrive at the net profit, at the profit before interest and tax for that particular year. Remember, after you lessing the operating expenses, you have to less the dividends paid, the provision for the taxes, the interests that were paid. So we need to add them back to the actual figures, and then we need to less the retained earnings that were brought forward. Because for us to arrive at the net profit for the year, we have to less dividends that were proposed and paid, the provision for taxation, and then the interest expenses. And then we have to add back the balance that was brought forward as regards to the retained earnings. But because we want to work backwards to arrive at the profit for the year before interest and tax, we have to add back those provisions, and then we have to less the retained earnings that was brought forward. Now, that will help us to have our beginning value here when we begin working out the number like we'll be seeing in the next video. Now, the other important area, before you begin working out, you need to put a check mark where for you to know if your statement of cash flow is on point or not. The opening and the closing cash and cash equivalents. So you will need to identify the openings that is going to be in the previous year, and then the closings are going to be in the current year. And then they will guide you when you become, for you to notice if your statement of cash flow is correct or wrong, because at the end of the day, the value you get here should be the same value that you will have gotten here as your closing. In other words, if you got 90 here, then you need to get 90 here as well. So you need to be very keen. If you get 90 here, then that means you need to have gotten 90 here as well. And then it also means if you got maybe here 60, then you must have gotten 60 here as well. Like we'll be seeing in the next video when we are working out a number. Executive consultants, let us learn together.